Welcome to the WTR Small-Cap Spotlight podcast. I'm your host, Tim Gerdeman, Vice Chair and Co-founder and Chief Marketing Officer of Water Tower Research. In today's podcast episode, I am joined by Corrado De Gasperis, CEO of Comstock Inc., NYSE ticker symbol LODE, as well as my WTR equity research colleague, Peter Gastreich. Comstock is a Nevada-based renewable and sustainable metals company with additional investments in renewable fuels, mineral properties, and real estate. Its high-volume solar panel recycling technology diverts end-of-life solar panels from landfills and recycles 100% of the commodities that go into them, to include, importantly, silver, aluminum, and other valuable and sometimes scarce resources. For more on Comstock's comprehensive business strategy and outlook, investors can look at Peter's recent initiation of coverage report. For today's discussion, we'll go straight into Corrado's strategy for Comstock to capture value from the precious metals market. So, gentlemen, without further ado, good morning and thanks for joining the podcast.
Morning, Tim. Thanks for having us. Pleasure to be here.
Good morning.
Corrado, I'll kick off the first question before passing it over to Peter for further Q&A. Let's start with the macro backdrop. Sans some very noteworthy volatility in recent trading sessions, silver has broken out in a way we've not seen in years. From your vantage point, what is driving the surge, and do you see it as a structural shift? And given where prices are today, how are you positioning the company to capture that value through your metals recycling platform?
Yeah, I do think it's structural, Tim. So, I mean, historically, silver has followed the gold thesis of investment in jewelry, and to that extent is always considered the poor cousin, with the gold and silver ratio being often debated. The historical 16 to 1 ratio that during COVID hit, I think, 125 to 1, and people were squawking at why is silver so undervalued? Why is silver so undervalued? But something meaningful changed about 4 years ago as well, and that was when the demand for the industrial applications, especially in electronics, be it electronics, photovoltaics, and evolving now into, robotics, data compute, the electronic explosion, the electrification that's going on globally resulted in, for the first time that I know of, that the demand for silver exceeded the mine supply. And these demands for, that are tied to electrification today are more than double the historical demand for investment and or jewelry, which is also increasing. So, so this structural change we saw 4 years ago, 2021, 2022, where the world is using 200 to 300 million more ounces of silver per year than the mines are producing. And on average, generally speaking, rounded, those numbers are produce about 900 million ounces a year globally from the mines or less, and now using 1.1 to 1.2 billion ounces per year. And so what seems to have happened, that is structural, that is foundational macroeconomic supply and demand, but it's also eaten its way through all the derivatives and all the trading and all the, to get to the foundation of we don't have the silver we need to make our products, and so I think from our view, and volatility has increased to your point, some people would say
Sure.
in a breathtaking way, but it's still remarkable where you have, let's say, a huge drop in silver and you're still looking at 75, $80 an ounce.
Right.
So I think we're going to see much bigger numbers. It's always difficult to predict, how it evolves, but it's foundational, and it is critical. It is absolutely critical to the effective use of these products. When people start talking about putting, solar arrays in space, you can't even begin to fathom, the magnitude of silver that's required for that.
Yeah, that all makes sense. And I will say, despite the brutal sell-off in recent days, a couple of very high-profile Wall Street market strategists in the last day or two have suggested that silver's in the very, very, very early innings of rallying. So,
I think so.
so
Yeah.
with that, I'll turn it over to Peter. Thank you.
Thank you, Tim.
Okay, thanks, Tim. So yeah, just moving on a bit further, continuing with Tim's question. Could you talk a little bit about just kind of broadly speaking how Comstock is positioning to capture
Yeah.
the value that you've just talked about in terms of precious metals through your metals recycling platform?
Yeah, absolutely. I didn't get into that part, so I appreciate the follow-up. So with us, the biggest dilemma that we see in our markets is that these solar panels came to end of life fully a decade earlier than expected. Each solar panel, on average, could have a half an ounce of silver in it. Okay. And when you look at some of the other people trying to recycle or reuse these materials, it's very ineffective. It's very slow. It doesn't scale, right? So one production line for us can produce reprocess, if you will, recycle 3.3 million panels per year. And you're talking about a high speed, high scale system where you're feeding in a panel every 7 seconds. It's all fully automated, and so in that context, one facility, even if you're thinking about maybe 90% recovery of the silver, using conservative numbers, you're probably going to be producing over 1.3 million ounces of silver per year. Two facilities in Nevada would be 2.6 million ounces of silver per year. And then it becomes very, very critical because you could do the math very quickly. 1.3 million times 75 or $80. It's very, very big value there. Then going downstream ultimately to refine those metals, and actually capture the substantial majority, of that metal rather than paying someone else to refine it is our two bastions, right? So capture the market, process as many of these panels as possible, reusing 100% of the materials, including and especially the silver, and then going downstream and further refining those metals so that you're not only getting all the silver, then you're getting the copper, you're getting the silicon, you're getting the gallium, you're getting the tellurium, you're getting all of these precious and critical minerals that would otherwise be landfilled and lost forever.
Okay, thanks very much. That's a great introduction. Let's move in a little bit into the economics of the solar panel recycling. Comstock in your IR presentation, you really very clearly lay out these economics. The model blends tipping fees, very low variable costs, and commodity sales.
Yeah.
For our listeners who may not be as familiar, could you please walk us through how the economics look at full scale? Especially now that high silver prices have increased the value of those silver-rich tailings.
Yeah, absolutely. So with one facility, and really to be more pedantic, one production line within one facility, we deploy about $12 million of capital for that production line. And we can produce, we can process, as I mentioned, 3.3, million panels. Now that's 100,000 tons, Peter. So let's use 100,000 tons as the simple rounded, basis for everything that we're going to say. These upfront fees, tipping fees, as most people will refer them to, we're providing a remarkable environmental service. We are immediately and completely eliminating a liability. And we're not eliminating it for our customers. We're eliminating it off the face of the earth. Yes, for our customers, but it's gone. We eliminate the liability and we get paid for that environmental service. I think there's a better word than tipping fee because it has certain connotations to it. We're providing a very valuable service quickly, expediently, completely. So that's $500 a ton. So that's $50 million of revenue right there. Previously, when we were capturing aluminum at $1,300 a scrap ton, and we were capturing silver at $35 an ounce and only recovering about half of it because the refiners charge us to process that stuff out and discount it accordingly, we were getting another $250 a ton. So 125 for aluminum, 125 for silver. So that's another 25 million of revenue. Put all of that, $75 million, against the all-in cost of $15 million. That's 4 million of totally variable cost. These extremely low variable costs result because the process of eliminating these contaminants, the process of processing these materials cleanly is super efficient. And so we use natural gas and we use electricity, which is about, I mean, it's substantially all of those totally variable costs. There's a couple other minorities in there, but I would easily say 92, 93, 94% of our variable costs is electricity and natural gas. So then about 11 million of fixed operating expenses. If you're doing the 100,000 tons, that's $150. So 750 minus 150 is 600, which is equivalent to about 60 million of cash flow per year from one production line in one facility. Now, if you wanted to be conservative, say, well, let's operate it at 90% rather than 100%, 55 billion. It's a big number. Now, that assumed $35 silver, where we're barely getting 50% of the value. At $60 silver, we're getting more than 50% of the value plus the higher price. So more yield, more price, and that adds another $25 million a year in revenue, literally another equivalent of $250 a ton. Now, most people say, whoa, you're talking about $80 to $85 million cash flow from a $12 million investment. Is that real? That is absolutely real. That is exactly what we're talking about. But in the same exact context, as much of as every time you think of, well, a $20 million increase or a $25 million increase because of silver prices, you should immediately be thinking we're leaving at least that much on the table by not refining the metals ourselves. So from a macro perspective, if you had a potential of creating, let's just say 75, 80 million of cash flow per facility, and we have a business plan to roll out 7 facilities, that's remarkable. Now, then we want to refine from there.
Okay, that's very compelling. But we'll come back to the refining in just a moment here. But you recently announced that Comstock secured all final permits for the Silver Springs facility.
Yeah.
You have equipment arriving. Where does commissioning on this first facility stand today? And how should investors think about the ramp up of this facility as well as your other planned locations? Nevada, California, Ohio. There's been a few announcements elsewhere.
Yeah, absolutely. So we're on schedule. We had originally guided that we would have the permits, by the end of 2025. We would be commissioning during the first quarter of 2026, which is right now, which is what's happening. And we would be up and running in the second quarter. Now, in terms of that ramp up, we have a very, very precise view of getting to about 25,000 ton run rate, which of course is only about 25% of 100,000 tons, getting to a 25,000 ton rate as quickly as possible. Third quarter would be great. Just get that up to that run rate. Why is that run rate relevant? Because we are profitable at over 20% utilization. So getting to 25%, we can prove, look at the system, look at the way that it operates, and look at the money that it's generating. That's unequivocal, absolute, validated proof of concept. Then ramping it up from that point forward, we would be happy if we exited the year, 35, 40,000 tons, and then exiting 2027 running full meaning typically somewhere between 90 and 95% utilization. So it's very, very exciting for us. What we just did was accelerate facility number 2, which will also be in Nevada. And I want to make a very salient point on these permits. These permits were first of a kind. Nevada has a very, very robust environmental regulatory infrastructure, primarily because it's the #1 mining jurisdiction in the world. So they're very knowledgeable about the complexities of air quality, water pollution, and all these kinds of things. But this was a first of its kind. And it's a state interpreting the federal rules. And so Nevada was very strict and stringent in interpreting the rules, which initially, quite frankly, was annoying, but with hindsight, it was remarkable because they basically held us to a standard that you're a recycler if you're not generating hazardous waste. So therein, the bar is set that you cannot generate hazardous waste, and therein, having a zero landfill solution puts us in an extremely rarefied space. Like, we don't know anyone today that has a zero landfill solution, hence we don't technically know anyone today that could qualify for the permits that we qualified for. And why is that especially important? Because Nevada, California, and Arizona represent easily 50% of the end of life market, and easily by far no one comes close, the biggest market in the United States. So we've established a beachhead right on the California borders, the California and Arizona borders, to take all of California, all of Arizona, all of Nevada into the most efficient, most expedient, most scalable infrastructure for solar panel recycling. Now, we did announce the California site, as you mentioned, and that was really in response to the myriad of customers in California, and to be able to service them better, more intimately, and ultimately give us some efficiency in how we coordinate our logistics back to Nevada. Because there's a lot, you don't want to be sending quarter trucks and half trucks. You want to consolidate, aggregate, and then bring it over when that's appropriate. Bigger customers, that's not an issue, of course. So then when we look out to Texas, Florida, Georgia, North Carolina, Ohio, even Minnesota as the hubs of where you see the most concentration of deployed solar panels. Worth letting the audience know, there's 1.4 billion solar panels deployed in the United States. Last year, we saw about 3.5 million come to end of life. This year, 4.5 million. But in 2030, that number is projected to be 30 to 35 million. It's a literal tsunami. But then you pause and say 35 million relative to 1.4 billion is a tiny tip of the iceberg of what's coming over the next 20 or 30 years. So it's hard to exaggerate the magnitude of this market, and the speed at which we capture market share, frankly, to us is the number one critical success factor now. Proving the tech was previously, commissioning and getting the first facility deployed, very critical. We're doing it right now, but ultimately getting that market share and making sure our customers understand this is the fastest, most efficient, and most effective way to terminate their environmental liabilities and keep domestic critical minerals in the United States as a strategic supply chain.
I just want to step back to the silver content, and you brought up the the refining as well. And there has been a little bit of investor misunderstanding about how much silver can actually be extracted from these panels at today's rates. And of course, you have your newly announced domestic silver refining strategy, which should help to unlock additional value. But maybe you can kind of walk us through exactly sort of where those recovery rates look today and where we could be going in the future with the refining strategy.
Yeah, it is. I apologize for any confusion, because there's really three variables here that we're talking about, and they're all relevant, right? The first one is how much silver is in each panel. And you see a lot of scuttlebutt about, oh, they're using less silver per cell. That's true. They're putting a lot more cells in each panel. These panels used to be 150 watts. Now they're up 600 watts. They're getting more in less real estate. So frankly, we see on average more than half an ounce of silver per panel. And we don't see any drop off in that as we project forward. Certainly not any material time frame that we can see forward. That's the first thing. The second thing is what we're doing now is we're producing very clean aluminum, selling it all, very clean glass pearl, selling it all, and then these silver-rich tailings. And these tailings, when we sell them to a refiner, we're only getting about 45 to 50% of the silver value net. So they say, well, we'll give you 75% of the silver value, but we're going to deduct transportation costs. We're going to deduct refining costs, which quite frankly, they dictate to us. We don't know what their refining costs are. So you're getting about half of the silver value. Now, back to our earlier discussion, it's very, very profitable for us in the current environment. Very profitable for us. But so the idea, though, is instead of yielding 45 or 50% of the silver value, and because of the way the math works, the higher the silver price, the higher the yield. But you're getting 60% at best. Instead of that, we would then like to deploy this integrated refining solution. And we wouldn't want to be refining at every recycling site. So if we had 7 recycling sites around the world, you'd only need one centralized industrial scale refinery to handle all of the tailings that are coming out of our plants. Typically, the tailings represent 10 to 15% of the mass balance. So even if you used 12.5%, the midpoint, you're talking about when you had 7 facilities up and running, you're talking about 80 to 100,000 tons of material. That would be a nice, very, very nice, centralized refining operation. Now you could have two, you could have one, let's say on the West Coast and one on the East Coast, and that would be nice too, because the CapEx that we're anticipating for the refining is not very high at all. It's a very well-known series of processes. What we're doing new is we're integrating it all, into under one roof, because we're not just recovering silver. We're then going to be recovering the silicon metal. And as I said earlier, the copper, the gallium, the tellurium, the various elements. And there's about 10 or 12, depending on the solar panel composition. And that's what's kind of new. It's very standard to extract silver from ore or tailings. It's very standard to extract copper from ore. But when you have a dozen of those elements, then you need to sequence the process and you need to optimize the recoveries in a slightly different way. So that's what we're talking about. Maximize the yield from the recycling center. B, tolerate or suffer a lower recovery by having to sell the stuff to refiners. C, optimize, maximize recovery by self-refining.
Okay, I'd like to pivot from your urban mining, so-called urban mining, with the silver and metals recycling, to the your traditional mining assets. So you have a legacy mining portfolio that's obviously become very interesting, where gold prices are at today. So with your Dayton and Lucerne assets fully permitted and highly sensitive to gold prices, how are you thinking about the timing, partnerships, and ultimately monetization of those assets?
Yeah, there's an interesting compare and contrast. I mean, from a first perspective, if you compare to the metal price lift of, gold hitting or pushing 5,000 and, silver being, in the $75 range, these assets become very, very valuable. I mean, the mine plans, show robust cash flows over the mine lives. And even, look, even at 2250 and 2500 and 2650, that's when it started to get very interesting to us, and it hasn't been that long though, right? It's been 12 months since then, and over the last 3 to 5 months, we've been getting a lot more serious, a lot more sophisticated inquiries about monetizing these assets. And people will say, well, why don't you just mine them? What are you doing? You could generate 100 million a year just from the Dayton mine alone. What are you doing? And the response is, it is very profitable. It is very lucrative, but compared to the solar recycling, the capital allocation is still highly, highly, highly prioritized to solar recycling. I was just saying this recently to someone that, and I just mentioned to you, if we can do 1.3 million ounces of silver per facility, and we have 2 facilities in Nevada, that's 2.6 million ounces of silver produced every single year. Now, this lucrative Dayton mine, and I say that very sincerely, I mean, we couldn't be more thrilled at the cash flow profile of that mine. It only has 2.6 million ounces in situ. So you're talking about a 7-year mine plan to extract 2.6 million ounces of silver. There's a lot of gold in there too, don't get me wrong, right? 2.6 million ounces of silver. And you're going to get, if you're really, really good, and we were when we were mining, 55 to 60% of that silver off of your leach pad. So it's very hard to say we want to put a dollar into that development versus a dollar into the recycling development. And there's no conflict there. We will be allocating the capital to the recycling. However, very sophisticated, very capable, very competent partners would be keen to come in and either acquire outright or partner or deploy the capacity there needed to access that value and that cash flow. And we're keen to do that. I think some of our investors, some of our investors love mining, but most of our investors are like, please God, don't allocate capital to the mining assets when you have the solar recycling opportunity just sitting there waiting for that capital. And I want to just reaffirm that's absolutely our view.
Okay, got it. I'll just put in one final question here before we get to your closing remarks. So you recently completed the Mackay transactions,
Uh-huh.
including the sale of your remaining NSR royalty. What does that deal signal about the underlying value of the mining district, and how should investors think about the economic leverage and strategic optionality that's embedded in your mining portfolio? You've touched on that a little bit already.
Yeah, no, I think it should be viewed as a very strong reinforcement. If you think about the entire Comstock district, the Dayton Spring Valley is the southern part, the Lucerne is the central part, and the properties that, Mackey acquired are in the north. The north is we had never had intentions of developing the north because it's deeper, it's more complex, right? It's actually also where most of the historic Comstock lode underground mining activities occurred, in the late 1800s. So some would say it's a little treacherous, up there. Is there gold and silver up there? There is absolutely gold and silver up there, but it would require a lot of exploration development dollars. So for a sophisticated company, including, their CEO is a very sophisticated geologist with a long history of good discoveries and successes. They see that value and they're willing to make the investment to develop that value. For us, we ultimately, since 2023, we monetized almost $8 million, in that claim set. But it would take tens of millions, if not hundreds, to develop, that complexity of geological structure. And they see real value in doing that. I think that's a strong testament to what people are seeing as possible. The Lucerne is near surface mineralization, and the Dayton is immediately at surface mineralization. So from a production profile and an ability to just jump in and mine those ounces, those opportunities are immediate term, near term and immediate term, whereas the north is a much longer term play, but still very prospective.
Okay, great. So, Corrado, thanks for taking the time today. This has been an incredible deep dive into precious metals, and it's just one aspect. So, multiple aspects that you have at Comstock, which we will, definitely address in future podcasts. It'd be great to have you back. I'll pass over to Tim in just a moment to wrap up, but just to, see if there's anything that we missed today, or would you like to leave any final thoughts with our listening investors?
Yeah, no, I would say that, what's really exciting for us is that we believe we have at least a 2-year lead in the solar recycling markets, especially the fact that we've been operating a facility for 2 years and now we're scaling it up. And now we've got these first of a kind permits that would be very, very difficult for others to achieve, at least in the biggest territory. So this recent capital raise was designed to accelerate the deployment, of those recycling facilities, capture, the vast majority of the market share of this rapidly growing market, and then lastly, get to it with, fully designing and fully validating a refining solution. If the refining solution didn't come online for 3 years, that would be wonderful for us because in 3 years we'll have at least two, maybe three facilities that are able to feed, that central machine to refine these metals for domestic production. So yeah, we're excited about the lead we have. If we don't move faster, of course, we feel that lead will shrink, right? Because it's a very big market, it's very attractive. Once people, figure out a little bit better on how to do certain things, they'll start coming in, and we don't want them to catch us.
Thank you very much. Tim, over to you.
Thanks, Peter and Corrado, for joining today. And I have to say, Corrado, as I put on my former equity research cap, you got my attention when you started talking about the total addressable market. Those are real numbers for a firm your size. So a very exciting story, and thanks for your time.
Thanks, Tim. Appreciate it. Thanks, Peter. Fantastic discussion.
Thank you for listening, and don't forget to subscribe, as well as visiting www.watertowerresearch.com to stay up to speed on the company's small cap written research reports, podcasts, fireside chats, industry-specific symposiums, and conference schedules. We will see you next time for another edition of the WTR Small Cap Spotlight podcast. Finally, a special thanks to the producer and editor of the podcast, Krista Fitzpatrick.